Welcome to section 2.7 of the foreclosure prevention class. This is regarding calculating your income. And this is a fun section. If you like math, I like math, so it's a fun section for me. Hopefully I'll make it a fun section for you. So the first thing we want to talk about is what are some common sources of income? Let's think about that for just a minute. Employment, self-employment, unemployment even, pension, Social Security income, or disability. Those are all different types of income. There's also rental income. They have a second, or third, or fourth property. Public assistance, that's still considered income. Survivor benefits, child support, alimony, those two are optional. You don't have to include those, but child support and alimony can be considered income. And then also optional could be income from a contributing household member. So you may have someone in the family who's not on the mortgage or on the deed, but they're contributing to the household. So as far as foreclosure is concerned, that income can be counted. Now different lenders may have different requirements for how you document that, but that's still income. So make sure we ask that question and we consider that. Now some tips for calculating income. When you calculate client income, you want to do it in accordance with standard lending practices. And mainly the reason for that is because that's how the lenders are going to do it. The lender or servicer will ultimately decide whether or not the workout is approved based on their income calculation. So it's really good to find out how they're doing it. And always remember to obtain current proof for every type of income. And what we usually tell our clients and our counselors as well is to, at the initial appointment, let your clients know that whenever they receive updated pay stubs, updated, if it's Social Security, they're going to get an updated bank statement showing the deposit. Have them send that in to you. Because as we know, this is not a quick process. So you want to make sure you always have the most recent information. So now let's talk about documenting the income. If it's a wage earner or a salary position, meaning if they're paid by the hour or they're paid on a salary, they're getting pay stubs, you want 2 of the most recent pay stubs, not more than 3 months old. And it should also, on those pay stubs, you should be able to see year-to-date earnings. They may ask for tax returns and even W-2s, so go ahead and collect that up front. If they're self-employed, more than likely they're going to want the most recent quarterly statement or a year-to-date profit and loss statement. Most self-employed people will know what you're talking about, but there are a few really small, business owners who may not. And in that case, it's really simple to print off a profit and loss or P&L statement off the internet and give it to them and have them fill it out with their income and their expenses. For self-employment, make sure you include the borrower's net profit plus any salary or draw amounts that were paid to the borrower. Benefit income. So that's, you want evidence of that. You want to get evidence of the amount and how often they're getting it. So for instance, if it's Social Security or if it's some sort of trust fund they're getting, they should have an award letter and they should have something showing how much they get and how often. You should also have bank statements to show proof that they've received it. So that's also very important. And then with rental income, you just want to get the last year's tax return and show the Schedule E, which is the rental income. If it's recent, then you may need to get a copy of the lease agreement and cancel checks. So now let's talk about how we actually calculate this income, because we're going with gross income, not net. And for those of you who may be new, gross income is going to be before any deductions come out. Net is what you actually bring home. So for an example, let's say we've got a homeowner who's making $1,550 a month, and they get paid once a month. Well, you just take that income and multiply it by 12, and that gives you the annual income. So that's pretty straightforward. But let's say they get paid semi-monthly. Semi-monthly means they get 2 checks a month. Sometimes you'll see it on the 1st and the 15th, or maybe the 15th and the last day of the month, but it's going to be twice a month. So that you're going to take the amount on their check, if it's $1,550, and multiply it by 24 to get their annual income, and then divide by 12 to get their monthly. As you can see evidenced here with $37,200 as the annual and $3,100 as the monthly. And then you have biweekly, and biweekly is often confused with bi-monthly, but please don't make that mistake, because that can be the difference between an approval and a denial. Someone who gets paid biweekly gets paid every 2 weeks. And you would initially think, oh, every 2 weeks, that's twice a month. Actually, it's not, because some months have 5 weeks in them. And so a biweekly person can actually get 3 checks in that month. So you want to take that $1,550, multiply it by 26 pay stubs. Because think of it, the year is 52 weeks, and if they're getting paid every other week, they're going to get 26 paychecks. Versus the monthly person who's only going to get 24. So when we do that calculation, they're making $40,300, which is very different from $37,200, and their monthly is $33,583.33. Now let's look at an hourly employee. An hourly employee, you're going to take their rate, multiply it by the number of hours per week they work, and then multiply that number by 52 weeks out of the year. That'll give you the annual income. And then you divide by 12 to get their monthly income. A little tip of the trade is if you take 52 times 40, you'll get 2,080. And so you just take the hourly rate times 2,080 for a full-time employee. Now where that doesn't work is if your employee only works 30 hours, 37 hours, etc. But if they say they work 40 hours, just take the hourly rate times 2,080. That'll give you your annual income. And feel free to print these out if you just want kind of a, until you get comfortable doing it. Once you've been doing it for a while, this will be second nature for you. Now we have this concept of grossing up. And this kind of confuses people because they're like, well, why would I gross it up? I'm not actually getting this extra money. But when we look at lending practices, they're using a certain percentage of the income. And the reason they use a certain percentage of the income is because they're estimating that you're going to have a certain amount of taxes and other deductions coming out. So for some people, Social Security, for example, where there aren't taxes that come out, we gross it up so that everybody's on the same playing field. So in this example, you see $1,200. We're going to gross it up by 25%, which is the standard. And so their gross monthly income we would count as $1,500. Now, 9 times out of 10, your lender is going to do this automatically when your Social Security income, so you won't need to gross it up. But you might make a note of it in the file that the actual income that you're using for calculating purposes is $1,500 versus $1,200. Now let's talk about rental income. Income from renting a portion of a bedroom or a property, and actually let's split it up. We'll start with primary residence. So let's say you rent out a room in your home, or your client rents out a room in their home so they can help offset expenses. They are renting it at $500 a month. Well, we have to calculate for vacancy, and that standard is 25%. So we're going to subtract $125, which means we can only count $375 as income for that particular homeowner. So let's think about that just for a second. We can only count 75% of the gross monthly rent as income. Now let's assume this is a non-primary residence rental. So your homeowner owns another home. Well, we'll take the gross rental income. In this example, we're going to say it's $2,000. We still have to apply that 25% vacancy loss rule. So in this case, we'll subtract $500, which gives us a total of $1,500 gross income. Well, now we have to subtract out the mortgage expenses, the mortgage insurance, association fees, any expenses associated with that home. So in this case, we've got $750 for the mortgage, $157 for the mortgage insurance, and $75 for the association. When we take all that, subtract it from the $1,500, we're left with $518 that we can count now towards their income. Now let's talk a little bit more about grossing up. Some forms of non-employment income are not taxable. Like I said, Social Security is one of them. Child support is another. If the income is not taxable, then the income is raised or grossed up by 125% of the actual amount received. So that's where that 25% comes in. It's easier if you just do 125 because it gives you the total amount. Whereas if you just do 25%, then you've got to add it to the current amount to get the 125. Let's do another example just to make sure we got it. So in this example, the client receives $1,670 per month for Social Security. To determine an affordable mortgage payment, the calculation would be as follows. 1,670 times 1.25 is $2,087.50, and that would be the gross income amount that we would calculate for someone with Social Security. Now there is an example on page 2 in calculating income, and I want you to go ahead and pause this recording right now and work out that and do that assignment, and then we'll come back and discuss it. All right, are you back? Let's look at client number 1. It says Rachel does data entry for a local small business. She works 30 hours per week and earns $10.25 per hour. She is paid by check once per month. She also cleans 4 homes per week and earns $75 in cash for each house. Note, when completing her computations, gross up income is necessary. So what is her gross annual income? Well, let's look at it. We'll take 30 hours times the $10.25 an hour that she works times 52 weeks. We get $15,990 is her annual income. That's for the data entry job that she does. Now she also does, she cleans homes for four homes per week. So 4 times $75 per times 52 weeks. That gives us $15,600. So her total income is going to be $31,590. Did you get that? Good. So what is her monthly income? Well, we take that $31,590, divide by 12, and we get $2,632.50. What proof of income do you need? Well, for her data entry, we need pay stubs and W-2s. For the work she does cleaning homes, she's self-employed. So we're going to need a year-to-date profit and loss statement, a Schedule C, and possibly some cancel checks. What questions or considerations do you have about her income? You mainly want to see how long she's been doing the house cleaning. If she just started, more than likely you can't count that. But if she's been doing it for at least 2 years, then that's income we can count. All right? Now I will let you do number 2 on your own. But keep in mind that on number 2, she's receiving Social Security disability. So you're going to have to gross up the $325 for that one. Okay? And let's just continue right along. We are at the end of section 2.7. So see, the math wasn't that bad. All right. Now on to section 2.8. We're done here.